Welcome to a Wiser Retirement podcast. Before we get started with the episode, I wanted to let you know about a new free ebook available on our website. This ebook goes over the top reasons most financial plans fail and covers what a quality financial plan should consist of. The link to download Top Reasons Most Financial Plans Fail is listed in the episode notes. Now on to today's episode.
Welcome to a Wiser Retirement podcast, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, guiding you to financial freedom with my co-host, Brad Lyons. Hey, Brad.
Hi, Casey.
Man, so before we get started, I did an interview this week with Randy Hargett. Randy is really our sole referral for life insurance, and I just wanted to talk to him about, financial success is intentional, and how does that apply to life insurance? And I thought he had some interesting updates on long-term care markets and just, what is a term policy, what is a whole life policy, things we talked about in the podcast in the past, but I thought it'd be good to kind of refresh that for our listeners. But man, I saw this, I thought about you. I maybe we talked about this yesterday. So there's a political commentator out there. His name is Matthew Iglesias. They say he's an American blogger, journalist who writes about economics and politics, right?
Interesting combination.
All of a sudden, he's only a political blogger. He's not a economics blogger at all, because here's a guy who's supposed to know all the things about finance, right? Because if you write about the economy, you should know it. Well, he got basis points in percentage mixed up. So he was saying the Fed has increased interest rates by like 25%. In a bond article he was writing, and the Fed doesn't increase by 25%. That'd be huge, right?
That would be.
It's 0.25, 25 basis points. Now, our listeners were going, I don't know what the difference is either. And so I did a video for you.
That's okay if they don't know, because they're not deemed to be experts.
Yes, that's true. Well, I have 2 points. One, don't feel bad if you don't know, because I didn't know either. I was in college, but I figured it out. Had as a guest speaker one time, and I was like, I don't know what he's talking a foreign language. But if you go down to the podcast in the note section, there's a link in there. Hadley's put a link in there for you. You can click on that. I did a little short video on what is a basis point versus a percent. So I won't waste our time on the podcast doing that. But it just tells me that you have to be careful believing everything that you read, because here's a person who's supposed to be an expert on the economy writing a financial related article who got the two confused. And what's interesting, that in his defense, he says, oh, well, my writing partner, who's also named Matt, found the error and I just never hit submit on the correction. I'm like, yeah, whatever. But with my aviation background, I see the same thing. The plane crashes. They interview an aviation expert about the plane, and it's all wrong. And you're like, everything you just said is wrong. Or they say the 737, and they're showing a picture of a Boeing 777. You're like, that's not even the same plane. Yeah. So when you know a lot about something, and then you read these journalist articles and how off they all are, but I don't know anything about a lot of things. And so I read the articles to learn, and I'm assuming that what I'm reading is right.
Well, that's the point. The assumption that you believe that it to be correct, because in journalism there's editing, or writing and editing,
right,
and publishing. The internet has combined those two things together, where the writer edits themselves and publishes all at the same time.
Right.
There's nobody checking this stuff whatsoever.
No.
But we read it and we think that it's accurate.
And
because
the
when you read
fact-checking.
the Wall Street Journal, there's writing, there's editing, and then there's publishing all at the same time.
Right.
So you presume that there's some accuracy, and when it's not, they'll post that they made a mistake. You see that little section in all the newspapers, but on the internet, that doesn't even exist. It's all self-publishing, No,
and this guy's big. I'd never heard of him. He's a little more left-leaning than I'd probably be reading about finance, especially. But it's something that popped up in the CNBC news feed, and I was like, that's weird. I didn't think that much about it until I was listening to the All In podcast. And that's a great podcast, by the way, if you want to listen to 5 different billionaires talk about jet setting to wherever to meet each other for lunch and do this podcast. It is like the #1 rated business podcast, I think, right now. But the bottom line is that when I heard it there, and I was like, oh, okay, I'll throw this out on our podcast too, I guess. But ultimately, don't believe everything you read. Yeah, that's really what it all. That's what it comes down to. And in separate news, ESG is blowing up, but we predicted that a long time ago. And,
we did. And we were all over that.
Yeah.
We saw it coming. You have these states now mandating that they divest their public funds of ESG.
What a mess. I remember talking to advisors when all this first rolled out, investing in only environmentally, social, governance focused companies. And I was just like, no, that's not something we need to participate in. Just wisdom just tells you that. But it's amazing how many advisors just do whatever it is they're supposed to be doing to win a client or to make them seem like they have the secret sauce, and there is no secret sauce. It's about perseverance. It's about having a plan, executing a plan. That's not a secret.
No, it's on our podcast.
Right. Exactly. Yeah. All right. Here's our interview with Randy Hargett. If you need life insurance needs, listen to him at the end of the podcast. He talks about how to connect with him directly, or you can always reach out to us. He does not upsell anything. Trust him with all of our clients. He's been a great resource for us over the years. Hope you enjoyed the interview, and we'll see you next time. Hey, I'm here today with Randy. Hi, Randy.
How you doing, Casey?
Doing good. It's always good to see you. For those listeners or who aren't clients, we've been using Randy for how many years now? Randy, are we like 5 years in?
I think it's 5 or 6 years now. It's been. Time flies when you're having fun.
We met Randy through the Dave Ramsey Network. He is, why don't you tell us a little bit about what you do with Dave and his team?
Okay. Well, I am a Ramsey trusted advisor for long-term care. Actually, I cover the whole states of Georgia, Alabama, and Mississippi for long-term care insurance for the Dave Ramsey fans. And that is how you and I got connected when you went on there to see who would call you. And it was me.
That's right. Well, the reason why we trust you so much is, in our planning process, we're able to say, hey, Mr. and Mrs. Client, you need to have this type of life insurance, or you need to have this type of long-term care policy. And you kind of take that and run with it. You educate them, you get all the quotes, you do all these things for them, and we really appreciate that. And most importantly, your integrity. There's a lot of people in your industry that always try to upsell. And I always tell our clients, is like, well, I'm gonna send you to a guy. He's not in Georgia, but he's not gonna try to sell you a Cadillac when all you need is a Toyota, right?
That's exactly right.
Well, our theme this quarter has been financial success is intentional. And so I thought about insurance and then you, and, when we think about being intentional with our finances, it also is protecting our family. And I don't know that we've ever had any clients that said, yeah, I don't want insurance. I know that there's conversations that people may have with their own family members or something, but typically wealth management clients are concerned about the downside as well as the upside. But if you think about a situation where you suddenly pass away and you're on a great trajectory, and all of a sudden all the hopes and dreams are gone, and maybe the parent, your wife or spouse has to move out of the house because the downsize, and they have to sell the car, and the kids can't go to the same college or schools anymore. There's ways to make sure that your legacy keeps going, even though you didn't make it to the finish line exactly, right?
That's exactly right. And of course, life insurance is a little bit different animal. Health insurance is one of those kinds of insurances that you need for all of your life. And when you turn 65, you'll get Medicare. And so it kind of is a stable thing. But life insurance, and people need to really think about life insurance a lot in the same vein that they think about other insurance products that they have. For example, your auto insurance, it changes every time you change cars.
That's right.
Your homeowner insurance changes every time you change houses. And every time a life event happens, or in the season of life, when a season changes, life insurance needs, they evolve over time. And because of that, at every season, every time there's a need, there is a need for another evaluation of trying to zero in on how much insurance that you might need. And everything you talked about is important, but when it comes to life insurance, there's really two types. There's term life insurance and permanent life insurance. And there's one called universal life that's kind of in the middle, but we'll focus on these two. Term life insurance is, you might put it this way, and if anybody's taking notes, you could write down, if I die.
Right.
Okay. If I died in this time frame, what would happen? Make the evaluation. Does the mortgage need to be paid off? Do I need to make sure that my children or my grandchildren's college education is taken care of if I died? And so that you could put that into different seasons of life. You know, early in life, I had a 10-year term policy that was just going to take care of my wife and children if I died.
Right.
Well, when I was in my mid 40s, I put in a 30-year term life policy that was going to take care of them if I died, based on what needs were for their income, because we already got the kids out of college and everything, and all that's, the house is paid for, so that's taken care of. So term life is if I die. Now, permanent life insurance goes into a completely different category, and you could just use the three words, when I die.
Right.
Okay. And there's where you're probably talking about a lot of other types of reasons a family might look at permanent life insurance. It might be for income protection. It might be, you know, if somebody has children and they need to get them out of college, they would do the if I die, the term life insurance. But if somebody has a special needs child and that need is going to go beyond their life, it's going to be a when I die situation to take care of their child. There may be a family that has a tremendous interest in helping people that need help. And so somebody that wants to leave charity to their favorite charitable organization might want to look at a permanent life insurance policy for that kind of thing. If there are going to be some significant inheritance taxes, which doesn't affect a lot of people,
Not anymore.
Permanent life insurance would fit there as well. And so that's just a big 30,000 foot view of life insurance and what it can do.
And it's a replacement. It's a replacement of income too in your early years, because you're not going to have that income anymore.
Absolutely.
In retirement is not as much. It could be in certain scenarios needed for replacement of income, but most people in retirement aren't going to carry life insurance because you're self-insured. If your term strategy went well, otherwise you probably should have bought that permanent policy, I guess. You know, another thing I keep seeing, Randy, we kind of laugh about this. We go through seasons here, but if you married someone that's like 7 to 10 years younger than you, we find that a permanent life insurance policy really should have been purchased probably shortly after the marriage date.
That's right.
It's really hard for us to complete a plan because you end up having to live off the same portfolio for nearly 40 something years, 45 years in some cases. And so a permanent policy, when you pass away, would then replenish your spouse's bank account to help them get through the last 10, 15 years of their retirement, right? So,
absolutely.
You know, I'm not a big fan of you know, whole life, universal whole life, especially when you're younger, because it's so expensive compared to just investing that money and using life insurance for what it's supposed to be used for. So many salesmen try to say whole life is an investment, and it's not really an investment at all.
No,
it's a drain on your investments.
It's not. And I would like to interject here, because a lot of people have a need for permanent life insurance for a death benefit.
Mm-hmm.
And if that is all that is needed, there is a category of life insurance in between permanent and term that's called universal life.
Yep.
And I've had a lot of our clients be very successful with that. The difference between universal and whole is that the permanent whole life insurance builds a cash value, which is why they tell you it can be used as an investment, but it is not a good investment for building wealth.
Yep.
But if you need it for income replacement or family protection, A universal life product will do that. It's a hybrid of a term policy.
Yep.
It's just that you get to pick the term, and you can
Right.
pick it all the way out to age 120.
Yes.
And it
But you have
doesn't
to
build
be,
cash value, and it's a lot less expensive to purchase than the permanent.
you also have to be careful though that you take it out far enough. My own grandmother had one that just about just caved in on itself before she passed away. So you do have to be careful. I think maybe a lot of those problems have been resolved with the newer policies.
Well, what it is people want the insurance, and you can get a different price on a universal product if you price it to age 85.
Yeah.
But it
Right.
won't go beyond 85, and it won't fulfill the intention.
Right.
Typically, we don't go any lower than 105 or 100, age 110.
To make sure it gets all the way through.
To make sure they're going to, when they die, that it's there.
Right. Exactly. You know, and then another way insurance plays in is really more in your wheelhouse, which is the long-term care. Have there been any major changes on that front in the last couple of years? I know everyone goes, oh, it's so expensive, because they hear from their friends it's so expensive, but it's not always terribly expensive.
It is not. When it's designed properly, it's not. Long-term care insurance is under the life insurance umbrella of insurance products, so it's governed by the same regulations. And there's actually a lot more choices in the long-term care marketplace today than most people think. And our philosophy, and this is part of our philosophy working with Dave Ramsey and his fans, is that you don't need to buy too much of long-term care insurance. Unless you have more than 7 figures of an asset base and you need catastrophic protection, there are some things to look at there. But for a typical family, you don't need to purchase a long-term care policy that's going to pay the full cost of a nursing home, because you're going to have income streams coming in. Even if you're laying in a nursing home, your income's still coming in every month. And so
Social Security, pensions,
pension, whatever. So simply put, what we say is that we don't want to design a plan to pay for everything. We want to design a plan that will be substantial enough to make a difference for our family. Within the past 3 months, we've had to file a claim on my mother's long-term care policy.
Oh, goodness.
She has Parkinson's diagnosis about 3 years ago, and that's progressive. Everything about long-term care, you can kind of see it coming on. And a year ago, she couldn't button her blouse or tie her shoes. And about 4 months ago, she got to the point where she couldn't cut her food up. Yeah. And she needed help getting into and out of the shower. And so all of a sudden, she had 3 activities of daily living that she needed. She was dependent upon somebody else to help her for. And so we have initiated her claim, and it is absolutely marvelous to be able to have somebody to come in and help my dad. It was actually killing him having to do all of this for her. And so
get the brunt of that for sure.
That's exactly right. And so we've had both situations happen in my family in the past year. My father-in-law had been sick for a while. They did not have long-term care insurance, and it was really a nightmare for the family to work together to try to do all of that to take care of him. And they put him in a nursing home, and within about 6 weeks, he passed away. So, what we're seeing is that there's a different way. And I tell all of our clients this, Casey, once you understand, and we spend most of our time when it comes to long-term care in the educational role, because most people, once they know how homeowners insurance works, they can decide what they want in their policy.
Right.
And it's the same way with long-term care insurance. And I can say this, in 20 years of being specialized in long-term care, we've not found anybody who could not find a place that they could afford. It might not have been what they wanted. My parents wanted $5,000 a month in their policy to pay for all this stuff, but they didn't want to pay that premium.
Right.
So they bought policies that would pay about $3,000 a month. Now, right now, do you think that we're glad that they got $3,000 a month that we can use to help care for them? Absolutely. And so you can find a place that you can afford. And, just like life insurance, like the timing of purchasing any kind of life insurance umbrella product is critical. You cannot buy any of these insurance products unless you're healthy enough to qualify for them. And that's my worst day on the job for life insurance or for long-term care insurance, is when somebody's waited so long that they can't qualify for it. And so basically, just like life insurance has these seasons of life where you need to protect your family for this amount of time if I die, or I want my family to be able to do this when I die, which would go to a permanent policy. Long-term care insurance, and there's a huge debate about when somebody should purchase long-term care protection.
Right.
10 years ago, our average age was 62.
Okay, which is probably, I would say, later than you'd want to.
Last year in 2022, our average age was 53.
Oh, wow.
And within the Dave Ramsey world, what we're finding is that more and more people are starting to work on his baby steps earlier in life. And so we're seeing lots of folks in their mid-40s that have a pretty substantial nest egg. And so there's 3 roads that cross. And when those 3 roads cross and intersect, somebody should look at long-term care. Number 1, do you have a nest egg that's worth protecting? Number 2, are you healthy enough to qualify for it? And number 3, are you at a point in life where you're ready to budget for this? And I'll give you a good example. We had a couple a few weeks ago they had the nest egg, they were healthy enough to qualify, but they still had 2 kids in college. And so it wasn't the right timing to budget for it. Another couple the same age had the nest egg and they were healthy enough, and their kids had just graduated from college. And so they were ready to put this protection in place. And so it is different for everybody, and it's not a one size fits all type of thing, but timing is critical on both life insurance and long-term care insurance.
And it's something that you have to purchase when you have the right amount of cash flow, especially these hybrid policies that are paid up. You got to have the right cash flow to be able to bankroll those payments for 10 years or 20 years. So thinking ahead on that, I had someone recently ask me about getting long-term care insurance. They were in their mid 30s. And I said, well, it's awfully early. She says, no, my mom is in care right now with early onsets of Alzheimer's, which I've never heard of anyone. I've heard 60. I've never heard anyone in their 50s with Alzheimer's. I know that it exists. But is there a minimum age at which you can qualify?
There are some policies that'll go down to, you can write somebody at age 18.
Oh, wow.
Most of the policies are like 30 or 35.
Yeah.
And that young lady or whoever you were talking to is smarter than she knows, because what's happening now in underwriting for both life insurance and for long-term care insurance is not only are they asking questions about family history, and that becomes a part of whether they'll approve you or not.
Yeah.
But if you have right now in long-term care, there's, I would say, all but 2 of the companies that are out there, if you have both parents, both mother and father, that had a cognitive disease, you cannot get long-term care insurance.
Wow.
And so now what you're having to do is to buy the insurance before both of them would get that diagnosis. Right. So it is pushing the age younger and younger. So again, to me, if she's in her 30s, it all depends on those 3 questions. Does she have a nest egg?
Right.
Can she get it? And can she afford to put that in her budget?
Right.
And if so, then there would not be any reason to not look at that, because even some of the hybrid plans now, you talk about changes in the market. Some of the hybrid plans now have changed to where you don't have to have a lump sum. You don't have to have large resources to purchase those. You can actually buy those on an annual basis, just like you buy a life insurance policy.
Oh, wow.
And so
what's I guess the benefit of that is if you don't use it, then basically you're getting your premiums back.
That's exactly right. Or more.
Yeah. So for those who don't know what that is, it's basically a life insurance policy that acts like, it's a long-term care policy that looks a lot like a life insurance policy. It's built on a
life insurance chassis.
Life insurance chassis. It's like an SUV built on a truck chassis, right?
Yep, that's right.
Basically, the idea is that like traditional long-term care, you're paying the premiums. If you don't use it, you lose it. Kind of like term insurance. If you didn't die,
and homeowners insurance.
And homeowners insurance. That's right. If the house didn't burn down, you never used it, or the pipes didn't burst. But with a hybrid policy, which is one of my favorites, if it's affordable for a family, if you don't use the policy, there's a death benefit, and that death benefit typically is a little bit higher than what the premiums paid in were, depending on
Absolutely.
how you structure that. So that's that's always my first choice. It just, for some people, it can be expensive.
And that's the only difference between people that buy the traditional and the hybrid, is if they can afford to buy the hybrid. And, it makes a lot of sense.
But isn't there return of premium now on the traditional long-term care policies?
In most of the policies, it is a rider that can be added, but it adds about 40% to the cost. So it makes
There's really
it cost.
no reason. Yeah. No reason to do that. Okay. Well, Randy, thank you for your time today. As always, I learn something every time we talk. And if people want to reach out to you directly, how would they do that? Well,
they can reach out to me. Our toll-free number is 1-866-582-4669. They can get me at randy@ltcstep.com. Like the baby steps with Dave Ramsey. This is the LTC step.
Long-term care
Randy at ltcstep.com.
Okay. All right, Randy. Thanks again.
Thank you, Casey. Y'all have a blessed evening.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening, that way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore. This podcast is strictly for informational purposes only and is not to be considered as investment advice or a solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investment advisor with the SEC. The host and/or guest may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guest of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.